Welcome to Secure Money Mindset, the ultimate podcast for financial planning tips and strategies. Our episodes are designed to be concise and to the point, lasting no more than 30 minutes. Each episode features seasoned advisors from Secure Planning Group or an outside financial specialist discussing crucial issues and providing actions to consider when addressing your top financial concerns. We value honesty and transparency, meaning we present both the good and the bad news in a clear and concise manner. Our goal is to provide you with reliable insights and practical guidance. Be sure to hit the follow button to stay up to date with our latest episodes. For more information, please visit our website at securepg.net. Let's dive into this week's episode of Secure Money Mindset.
Hello and welcome back to the Secure Money Mindset podcast. I'm your host, Mike Lenge, and with us today we have Marty Minder and Kevin Ralph, two of our financial advisors here. And the topic today, we're going to talk about Roth Conversions. So jumping right into it, we're going to ask Marty kind of to get us started with what exactly is the difference between a Roth IRA and a traditional IRA and kind of the purpose of the conversation of a Roth conversion.
A traditional IRA is going to be pre-tax money that's never been taxed. It's going to grow tax deferred. And when you go to pull the money out of the IRA later in life, it's going to be taxable at your income bracket at that point. So a Roth IRA is going to be after tax money. It's going to grow tax deferred and come out tax free. So you can see there's a big difference in how the taxation works between the two. Part of what a Roth conversion does is going to take some monies from the traditional IRA, which is going to be taxable when it comes out, and we're going to convert a portion of that or all of it into a Roth. What happens in that respect is you're going to pay your income tax on whatever portion you convert at that point, but then the money now becomes inside a Roth IRA where it can grow tax deferred and come out tax free later on in life.
Perfect. That's a good kind of baseline to get the conversation started. If you don't mind, Kevin, touching on some of the benefits of performing what we call a Roth conversion.
Sure. So generally speaking, we personally think that tax laws are likely to be higher in the future. So if we have the ability to pay the taxes today in lower tax brackets, convert them over into the Roth and have them never be taxed ever again when tax laws might be higher, that's one of the main benefits to it. And as far as other benefits with the Roth conversion, we tend to like to do it when people first retire because they generally, at that point, go to a lower tax bracket, and that allows us to get more monies over into the Roth. And we generally look at it as far as, if somebody's, say, in the 20% tax bracket, how much room do we have to get them into the 22% tax bracket without increasing the tax burden? And there's also a lot of benefits for estate planning, which I think we're going to hit on here in a little bit, but a lot of benefits when it comes to estate planning down the road too. So it benefits the people who are living and have the Roth IRAs, and it also benefits for their heirs down the road too.
Kind of along those lines, and you kind of touched on it with people who are just entering into retirement, is anybody a good candidate for a Roth conversion, or is there a specific type of client?
I wouldn't say that anybody is a good candidate. It definitely is per client as to whether or not we would suggest it. It is something that we look at for every single client we talk to, and it's definitely worth the conversation. But we do like to get the accountants, the CPAs involved to make sure that makes sense. It depends on, does our client have kids that they want to pass on assets tax-free? So there's a lot of different variables. I wouldn't say just across the board it makes sense, but generally speaking, it is a conversation we have with our pre-retirees and our retirees probably every single year.
And then, Marty, when you're performing these Roth conversions, is there a specific type of asset class, or what types of positions within a portfolio do we typically look to use within these conversions?
Well, when it comes to the Roth conversion, your monies now are in a asset tax protected and no further tax ever due on it. So that's where you want to have your aggressive assets. Typically your equities are going to be in that spot, because the idea behind that is if you paid your tax on X, we want to try to grow that as much as possible because it's never going to be taxed again. That's where you're going to have your aggressive assets and basically equities.
One thing I'll add on that too, talking about timing of Roth conversions, we like to do it when the market is not doing too well. Because to Marty's point, if you think about it, if we have depreciated shares inside of a traditional IRA, we can move more shares over into the Roth and let them reappreciate over into that tax-free bucket. And there, in turn, we have a lot more dollars over there that are grown tax-free.
And a tax savings over the lifetime of the
Correct.
account.
Correct.
Yeah.
So we can convert more, keeping the person in that tax bracket at the right time when the market's a little volatile.
And I think that that's important in terms of thinking of the value that we bring as financial advisors is we work closely, as you mentioned, with the CPAs and the accountants and things like that. But our role is to look at that over your lifetime, not just within a given calendar year. And the whole concept of Roth conversions is focused on exactly that, is not just looking at your tax status today, here and now. It's thinking about over your lifetime. If we're drawing down on these accounts, we want to make it as tax efficient as possible.
Correct. Yeah, sometimes we will butt heads with the CPAs. Their job, like you said, is to save tax dollars today. Our job, like you said, is to save tax dollars over the lifetime. So we do like to make sure that everybody's on the same page when it comes to that conversation.
And part of what we try to look at it too is on an annual basis. You don't have to convert your whole IRA at one time. Sometimes, like Kevin had mentioned earlier, you might have a little space in the same tax bracket you're currently in anyway. So we can convert just that portion. So your tax brackets don't go up, but then we start converting big chunks from traditional or little chunks over to Roth where you never have to pay tax again. So it's an annual discussion that we have with our clients as to how much we want to do on an annual basis or if we want to do it at all.
And that kind of transitions us to that next question is, when you go to execute these conversions, what, like that tax liability that we're talking about, how does that work? Like, how do you pay down those tax liabilities as you make the conversions?
So ideally, we prefer people to have the cash inside their bank account to pay that tax bill. Because if you think about it, if they don't have that cash to pay the tax bill, that means that we're going to have to take more dollars out of the traditional account to pay the tax dollars. Not going to say that we won't recommend people do that, but the ideal scenario is that people have the money in their bank account to pay that tax bill once we do the conversion, and that way we can get the entire amount over to the Roth IRA.
Perfect. Now, you had mentioned, Kev, estate planning and how Roth conversions could potentially factor in there. Marty, could you maybe just expand on kind of how it can be viewed as a tool for estate planning?
Sure. When it comes to estate planning, it's a phenomenal tool to pass on your assets. If you're an older client and your objective is you're probably not going to spend some of these monies, and we have a large traditional IRA, but you have several children or grandkids, you want to get those assets too. It's one of the best vehicles you can think of because you're taking taxable income that would go to your kids, and theoretically they're going to be in some of their main earning years. They're going to be in their higher brackets as well. So they're going to inherit an asset that is now in a Roth, which they can take out tax-free and not get added to their tax burden at that point in time. It's the best way you can do it besides a life insurance policy that's also tax-free. So realistically speaking, if we have clients that have more money than they need, we can start taking a look at changing traditional IRA monies to Roth, and then basically leave that account alone and have that be an inherited asset, which the children and grandchildren are going to be able to enjoy for no taxes.
And just to add on to that's a rule that changed in the last couple of years. What year was that?
Like 2020.
2020. You used to be able to stretch the traditional IRAs out over your lifetime, but unfortunately, they changed the rules that now people who are inheriting those traditional IRAs got to take it out over a 10-year period. So prime working years, income added on. If we can convert it to the Roth, they still got to take it over 10 years, but all tax-free. So that's the main benefit to estate planning. And Marty mentioned life insurance. Unfortunately, not everybody can get life insurance, or sometimes it's very expensive. So at least we can guarantee getting the monies over to the Roth that way.
Yeah, I think that's been a pretty good summary. Was there anything that you think we maybe missed or didn't touch on in terms of how clients should be viewing this type of conversation with a financial professional?
I think this is especially if you're an older client in retirement and you have an estate that you're trying to preserve or get down to the next level, a Roth conversion should be part of your conversation at every meeting you have. The timing of it should be considered, tax bracket you're in should be considered, and the amount you might want to convert that year, maybe not convert. That's something that should be part of your conversation every year.
And just the only other thing I would add is the sooner we get a chance to talk with younger clients and educate them on if it makes sense for them to be saving Roth dollars, that's less Roth conversions we have to do down the road if we can help the younger people save into the Roth buckets that are very advantageous buckets.
And I guess just to summarize from my perspective after listening to you guys is the moral of the story: working with a professional to help you navigate these types of conversations is always important. But we want to take a lot of the thinking out of the client's hands. We want to make it very streamlined for them. And at the end of the day, it all boils down to what works within their given plan, which is specific to them. So I appreciate you guys talking through this with you guys or with us. And we hope you guys will join us here on the next time. So if you have any questions, feel free to reach out and contact us. And we hope you enjoy the content.